You know, in today's world, one of the most powerful weapons in geopolitics isn't a missile or an army. Nope, it targets something way more fundamental to how our global system works: money. We're talking about economic sanctions. They've become this go-to tool for governments, and their impact, well, it goes way beyond politics. It's shaking the very foundations of the global financial markets. So how did this all happen? And what does it really mean for the rest of us? Let's dive in.
This quote right here, it absolutely hits the nail on the head. We've seen this massive shift where the modern battleground isn't physical anymore, it's financial. It's a world where capital flows, banking networks, and who gets access to the market. Those are the new levers of power. The idea is to apply pressure not with brute force, but with finance, turning a country's own economic connections into a weapon against it.
And these financial weapons, they have a name: economic sanctions. Make no mistake, these are designed to be incredibly precise, incredibly powerful, and they are completely reshaping how money moves around the planet. And that creates all sorts of new risks and challenges for literally everyone in the global economy.
So how did we get to this point? Well, this whole rise of what we call economic statecraft is a huge strategic pivot. Instead of sending in troops, nations are more and more just flexing their financial muscle to get what they want in foreign policy. It's turned the markets into a direct extension of the geopolitical chessboard.
Okay, so to really get a handle on their impact, we need to crack open the playbook. Because, and this is key, not all sanctions are the same. They work in different ways, each one designed to put a very specific kind of economic squeeze on a target.
First up, you've got the classic tool in the toolbox: trade sanctions. I want you to think of these like a physical blockade. The whole point is to cut off the flow of actual stuff: goods, services, and crucial commodities like oil or microchips, basically trying to starve an economy of the things it needs to function.
But the real game changer, especially in our hyper-connected digital age, is the financial sanction. This is a whole different beast. Instead of stopping trucks and ships, these measures stop the flow of capital itself. We're talking about freezing billions of dollars in assets with the click of a button, cutting a country off from international banks, and pretty much unplugging them from the global financial grid.
And this slide really lays out the difference perfectly. Over on the left, you see trade sanctions. They're often slow to bite, and their impact can be pretty broad, sometimes hitting everyone indiscriminately. But on the right, financial sanctions are like a surgical strike. They are lightning fast, they can be aimed at specific people or companies, and they hit right where it hurts the most: the ability to move money.
So this financial playbook has some seriously powerful tools. We're talking about asset freezes that can lock up fortunes overnight, banking restrictions that make it impossible to send or receive money internationally. And then there's the nuclear option: cutting a country's banks off from SWIFT. You know, SWIFT is the messaging system that underpins basically all international finance. It's the glue holding the whole system together. Getting kicked off is a huge deal.
All right, so now that we know the tools, what happens when they're actually put to use? Well, the effects aren't just contained to the target country. Not at all. They send these immediate, powerful shockwaves tearing through the global markets. Let's take a look at what that actually looks like.
Yeah, this is the big question, right? It's the one every trader, investor, and analyst asks themselves. The second that sanctions are announced, markets have to react, and they react instantly to this new reality.
Let's start with commodities. Say sanctions get slapped on a major oil and gas producer. The market immediately starts freaking out about a potential supply shortage. And as you can see in this chart, just the fear of that happening is enough to send prices spiking, which means energy costs go up for everybody, all around the world.
Then you've got the currency effect. For the country that's being targeted, sanctions create this massive cloud of uncertainty. As this chart shows, it's a mix of things. Investors get spooked and pull their money out. That's capital flight. Trade gets all messed up, and just general confidence in the economy completely evaporates. It's a toxic combination that can make the country's currency just plummet, sparking inflation and all sorts of economic chaos.
And look, this damage spreads across pretty much all asset classes. Let's just walk through this table. For stocks, you see wild swings, high volatility, driven by that raw geopolitical risk. For the country's bonds, the impact is sharply negative because investors are suddenly terrified the country might default on its debt. And like we just saw, commodities can see huge price spikes. The main takeaway here? No corner of the financial market is safe from the fallout.
But you know, the story doesn't stop with these initial market fireworks. The really deep, long-term impact of using sanctions this much lies in what we call the second-order effects. These subtle but really significant cracks they can start to form in the entire global financial system.
Yeah, these are the aftershocks, the consequences that build up slowly over time.
This ripple effect goes way, way beyond those first price swings we saw, and it starts to actually change the rules of the game for everybody.
Now, what's so fascinating here is what we call the cascade effect. It all starts with a banking restriction. That immediately creates this huge headache called counterparty risk, which is just a fancy way of saying global banks get really scared to do business with anyone, even remotely connected to the sanctioned country. They're worried they won't get paid back. That fear makes capital flight even worse. And finally, it forces the sanctioned country to desperately find a way out.
And that search for a way out leads right here, the creation of totally alternative financial systems. It's a survival tactic. Sanctioned countries start building their own parallel networks for payments and trade that are specifically designed to go around the traditional Western-led channels. We're seeing this with things like China's SIPs or Russia's SPFS payment systems. And over time, this could actually start to break apart the single global financial system we've all come to rely on.
So all of this forces us to take a hard look at the future. We're walking into a new era of weaponized capital, a world where investors, companies, and governments all have to figure out how to navigate a financial system that's becoming a lot more complicated and a lot more fractured. At the end of the day, this is the real takeaway. That old, clear line between Wall Street and Washington, or between finance and foreign policy, it's gotten really blurry. Economic sanctions aren't some obscure tool anymore. They are a central, powerful force that's going to keep shaping how markets behave and how our global economy is structured.
And that leaves us with one heck of a final question to chew on. As this new map of global finance gets redrawn by all these geopolitical pressures, we all have to face a new reality. In a world where capital itself has become a weapon, where is money truly safe anymore?